Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode. Today, I want to talk to you about the top 10 myths about mortgage note investing. As people who are not very familiar with mortgage note investing typically have their brains always go to like worst case situations, especially when we start talking about non-performing loans. And I want to talk about some of these myths because many of them are just that. They're myths, not reality. And let's go through them. And I want to spend the next 20 minutes or so just talking to you about explaining the realities of what mortgage note investing is, because there isn't a lot of information out there for people to understand more about investing in this alternative investment. Case in point, I was in real estate for 20 years before I even knew this existed. So let's get started. First myth is mortgage note investing is extremely risky. And the reason I add the word mortgage before note investing is make sure people understand mortgage notes are backed by real estate. That's the safety net. Now, with proper due diligence, being able to purchase loans at discount, there's ways you can minimize risk. But I just want people to realize that there's different types of investing. And a lot of people invest in basically like, oh, I gave somebody in a syndication money and they gave me back a note. So I'm quote unquote note investing. For example, there's a fund out there that was investing in Broadway plays. And people were like, I have a note. So they thought it was note investing backed by real estate. That wasn't the case. So mortgage note investing is when the loans are backed by real estate, and that's what the company is doing. It's not what you hold, whether you're a bond holder or a shareholder with the company. It's what is the entity doing? And is there risk involved in investing? 100%. And anybody that tells you that it's risk-free or guarantees any type of return, they are full of it. There is risk involved in any type of real estate, whether it's mortgage note investing, short-term rentals, multifamily, commercial, self-storage, mobile home parks. Everything has risk. Now, one of the benefits of most mortgage note funds is they don't take on leverage. So leverage can enhance returns, enhance risk. So mortgage notes typically don't take on that leverage, which can impact some of that risk profile. Myth number 2, I get this asked all the time. Well, you're always foreclosing on people. And reality is, yes, foreclosure is an option. It's usually not our primary goal. In fact, we typically want to work with the borrowers to restructure the loan and allow them to stay in their homes. But also, of course, we need to maintain some level of profitability. But with foreclosure, when we underwrite our loans, we underwrite them to make sure that they work based on restructuring the loan with the borrower. Our foreclosure rates are extremely low. As we mentioned previously, they're under 10% of the time we foreclose. And in many instances, it's when the borrower doesn't come to the table and want to work with us, or they're also deceased. So those are primarily the two main reasons why we end up foreclosing. But it's not that we're just buying loans. People think 2008 and, oh my God, we're wiping everybody out. 2008 is not going to happen again. And again, I shouldn't say it's not going to, but I can't envision a situation where it would because there's so much fraud back at that point in time. Could there be something that impacts real estate values in the lending business? 100%. But what happened in 2008 was unique. Myth number 3, only wealthy people can participate. And that was the case before the Jobs Act and Regulation A+ offerings. Most people don't even know what a Regulation A plus offering is. Most people think I got to be accredited. It's a $50,000 minimum. Again, furthest from the truth. Our fund is open to a wide range of investors. You can start in our fund with minimum $5,000 and do not have to be accredited. You have to be 18, but $5,000 minimum investment to let people invest in these types of opportunities. So I see on forums all the time people saying, oh, I'm looking for a place to invest, or why can't anybody take non-accredited investors? There's lots of places out there. People just need to look for them. And Regulation A offerings, which do go through more scrutiny. You have to get qualified by the SEC. You have to do different types of reporting that are out there. But it's not only for wealthy investors. Next myth is that we own the physical real estate to the property. We don't. Again, we are the lender. And the simple way to let people understand is most people, when you buy a home and you have your financial institution giving you a mortgage, you pay them your mortgage payment every month. And usually within 90 days after you get a loan, you'll get a letter in the mail saying, hey, your loan has been sold. Please now make your payments to XYZ. So again, most people forget about that, but your loan was just sold. Now, who was it sold to? Most likely it was probably collateralized in a mortgage-backed security. But let's say I bought it. I could buy it. Now I'm your lender. You make payments to me. But if your roof leaks, do you call me? Nope. If your toilet breaks, do you call me? Nope. You need to paint the outside of your house? Or the steps railings are loose, do you call me? Nope. If you're renting, in every situation, call your landlord. In these instances, we're just your bank. We're your lender. So we do not own the physical real estate. We are the bank. We're the lender behind it. Number 5 myth is non-performing notes are bad investment because how do you get people to pay? And truth be told, they can be a great opportunity because you can buy them at a discount. Would you tell somebody that was buying your neighbor's house that, let's say it was an elderly couple living there, they passed away, the house hasn't been updated since the 70s, and they're buying it at a discount compared to, they're paying $400,000 for it, and all the houses in the neighborhood sell for $800,000. Would you tell them, oh my God, that's an awful investment? Or would you be like, wow, how can we make that investment? Probably be, wow, that's a pretty good investment. Same thing with non-performing notes. As we mentioned, we fix and flip the loans, meaning that you're in some type of distress, just like this property. We work out a strategy to enhance the loan by getting the borrower reperforming or other exit strategy or alternatives. And then we increase the value. Just like that neighbor would probably go and put new carpet, paint, kitchen, within the physical asset. We're trying to get the borrower back on a payment stream because what makes a note valuable is payments coming in the door. And by doing that, we enhance the value. Then we go to sell it on the secondary market for a premium. Now, there are plenty of notes that are bad investments out there, and I've done plenty of episodes on that. But when people hear non-performing, they think of, how do you get paid and all these other things. Think about buying a house that might need a little, elbow grease or handyman special. Depending on how much handyman is needed. Similar notes. Some of them are really bad and could take a lot and have high risk, high return. Again, that's not the ones we look into. It's equivalent of like almost demoing a house and rebuilding it. We're looking, the equivalent of get some paint, new carpet, and move on. And again, we're not owning the physical real estate. I'm using that as an example so people can relate. Myth number 6. Returns are too low compared to other investment strategies. What investment strategies are you comparing it to? Stock market historical returns are between 7 and 11%. Real estate is typically historical, on average, between 7 and 11%. We're at between 8 and 11% annualized return. Now, I know people say, well, I invested in a multifamily deal and I got 20%. Many of those multifamily deals also lost all of your equity recently. But let me explain the difference. And this is where a lot of people make grave mistake. They only, and this is the one thing they do, is look at who's going to give me the best return. That's like looking at a car without knowing any options inside it and just say, I'm going to buy the cheapest car. Doesn't have, and you live in, Maine, doesn't have heated seats, doesn't have anything, basically, is that really the best, situation for you? Might not be. But when you're only looking at that number or that return, not analyzing the risk, you're probably going to fail or lose. To understand that, yes, higher returns have higher risk. And I saw somebody post in a forum group the other day. I'm looking at an offering that has 70% debt, 20% investor equity, and then like 10% common equity. So the owners are holding 10%, not putting anything into the deal. They're getting 70% loan from the bank, and they're looking to target the rest from investors. When you're leveraging at 70%, ask the question of sensitivity analysis. What if the rents don't get what you need? What if interest rates don't go down or you can't refinance? That 18% you're targeting can quickly go to negative 18. Understand, people are punch drunk on recent returns that they've received over the last few years. Where are those returns today? And just understanding over a historical perspective, where things fall into play. Myth number 7. There's not a lot of mortgage notes available. I've never heard of this. How do you buy enough loans? If you raise $50 million, you can't get that out the door. This is probably the biggest myth. People realize that the mortgage market is a $13+ trillion industry. More than half the loans get sold. And on the non-performing side, where we're at all-time lows today, there's typically anywhere between 2 and 600 billion with a B. If there's 500 billion out there, and that's just what's reported. This doesn't include all the other, investor loans that don't have to actually even report. So the number is actually probably closer to 750 to a trillion, but now I'm just throwing spaghetti at the wall. So I'm looking at like how many zeros? 1/100,000, 1/10,000, it's a huge industry. And we see on average, 5 billion in loans per quarter. And the amount of non-performing loans does fluctuate that we see, but it's significant. And we've never had a continuous period of we're like pulling our hair out saying, oh my God, I can't find any loans. Might not like the pricing that we see on them, but we see plenty of loans. And just remember that, it's $1 trillion industry. Similar to like saying, I can't find a property to rehab, fix and flip, to buy, rent. You can find properties. There's still millions of, I'm guessing, I don't know how many houses across the country are on the market right now, but it's, which ones fit your buy box or criteria. We have a pretty wide criteria for first position loans we target. Myth number 8, mortgage note investing is liquid. It's not. Now, the reality is it's not. Whether you're buying a note yourself or investing in a fund, I don't consider them liquid. What I mean by liquid, to me, when I look at liquidity, I look at a stock that I could sell that thing today in a heartbeat. I view real estate in general as illiquid, because you have to, go through a process that can take 30, 60, 90 days to liquidate that asset. So to me, that's illiquid. Now, there's different variations of liquidity, but to me, it's not a liquid. So if people want to use mortgage note investing like a bank account, whether it's independently investing or in a fund, not recommended. Because I don't care what people tell you where it's like, oh, it's liquid. It isn't. So be careful. Myth number 9. You have to deal with the borrowers yourself. Well, let's be honest. You invest in a fund, then you're just a limited partner. You're not dealing with borrowers. But if you're also investing in a mortgage note, that's why you hire a servicer. And we pay $35 a month for them to deal with the borrowers, send out the statements, file the tax forms every year. It's actually a pretty good deal in my mind, not having to deal with the borrowers. When you have to manage the servicer, the day-to-day is through a servicing company, and we don't have to manage those borrowers. So something to understand when people look at investing with us. Oh my God, how much staff do you need to deal with all these borrowers? It's a watching the grass grow process in some of the dealings because of getting legal involved, and also understanding how to manage. But part of it is by using a servicer, it allows for better management. Myth number 10. Mortgage note investing is correlated to real estate values and or the stock market. To me, I believe this is the furthest from the truth. And here's the example I'll give why. People don't wake up one morning and say, I'm not going to pay my mortgage. Also, if the stock market for most people goes up or down, it impacts your retirement funds. It doesn't impact your day-to-day spending. The stock market goes up 10%, down 10%. Me and many people I talk to, they just wait it out. They're not going to say, I have to sell my house because the stock market went down 10%, or I'm going to buy a new house because the stock market went up 10%, especially on the defaulted side. Most people who default on their mortgage aren't heavily invested in the stock market. So, non-correlation number 1. Second is real estate values. Again, we're first position fixed mortgages. And you as a listener, if housing drops 10% or goes up 10%, you're on a fixed mortgage rate, not variable, adjustable. Does that change what you do? Are you going to default because your home value dropped by 10%? Most people answer that is no. Think about it. You might sell to move up in the world, but what is correlated to people not paying their mortgage? 2 things. One is increased expenses, inflation, taxes, insurance, kids getting older. I have my son now. He's a teenager. Amount of food he's eaten. That's one. What's the other? Reduction in income. Job loss. So those are correlated with mortgage note investing. Now, stock market impacts companies, which can impact jobs. So there's a level of correlation there. Home prices can impact how much you potentially can collect on a mortgage. So there's some correlation there. I'm not saying they're completely uncorrelated. What I'm saying is, from an inventory perspective, what we focus on is the job market and inflation. Now, the other myth is because people are thinking, oh man, rates have gone up and inflation is high and home prices are coming down now, so that's a bad time to buy non-performing notes. Well, it's actually the opposite. Is what's happening now. More people are going into default. More people are struggling to pay their bills. Increased inventory, when there's oversupply of anything, what happens? Prices go down. So oversupply of non-performing loans, will lead to lower pricing. Now, how does that impact us going to sell the assets? Performing loans have traditionally always been pretty close to selling for the same numbers. 8 years, I can tell you performing loan fluctuate values, little fluctuations. Non-performing, over the last several years, yes, pricing has gone up on non-performing loans, specifically due to reduction in inventory because government printed a lot of money, people had more money, people weren't losing their jobs. Inflation was helping them, because it really hadn't hit, or the cost of taxes, insurance, and food hadn't hit until it's starting to hit now because it lags by several years. So last one I think is the most important and a big misconception, because people look at a mortgage note fund and say, oh, I think price is going to go down. I don't want to touch it. Actually, could be one of the best opportunities out there compared to other opportunities out there that leverage, take on leverage, because when you take on debt, when it's more expensive, for example, a multifamily or an investment property, it's harder to make those returns. For those who are listening who are a, rental property investor, you try and go get a loan today on a rental property that you're buying that property because of the value of the property in your mortgage rate. You make that cash flow. Homes that cash flowed 3 years ago, 4 years ago, you're not going to get them cash flow today. It might not be a great investment. Something to consider as part of any balanced portfolio is look at alternatives like mortgage notes, understand the risks, make sure listen to what we said here about some of the myths and understand it. Do your own research. And if you have any questions, please reach out to us. We are always happy to provide you with additional information. And as always, as I wrap up this episode, make sure to leave us a like and share on your favorite listening station. Take care, everyone. Thank you. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.